So now that you've learned the 4 basic types of trades that you're going to be applying OFA with, it's important that you get an idea of how to build out some of these algos. So I'm going to take you through the algos for the 4 different trades. Now there's really only 3 algos because the last 2 types of trades, breakouts, breakdowns, and double bottom, double tops, use the exact same algo setup. So it makes it really simple. So we're going to start with the basics here, and I'm going to do this in MotiveWave, but it's exactly the same in Trade-Evade, and when the Algo X interface for NinjaTrader is complete, it will be exactly the same as well. So it shouldn't matter which platform you're using. What we want to do is go in and create our first algo. So in Algo X, it's just this little pencil up here that will open up that dialog box. And what we have to do is think about the algo that we're trying to build. There's 3 different pieces to it. The first part is the execution. Okay, so when we say execution, what we mean is we know we're going to be sending an order somewhere. So in this particular example, for a swing trade, I'm going to be sending the order to the CWAP, and I may want some variation off of that. Okay, so I may want to send it a tick in front, or 2 ticks in front, or 2 ticks behind, or something like that. So anytime I send an order, I'm going to be using this drop-down. So if I want to send an order to the CWAP, and I want it to be, for example, 1 tick in front of whatever the current CWAP value is, so if I wanted it to go in at 49.08, I would use 1 here for the offset. Okay, I'm just going to set it to 0 so it's exactly at the CWAP. So we know that where we send the order is not controlled by the execution algo. So what is an execution algo? Well, look, if we open this up and we add an execution algo, okay, so what I'm saying is I know where I'm sending the trade, but how we execute it is what I'm trying to define. So I want to name this, and we know that for this particular type of trade, I'm going to be using the CWAP as the entry for the swing, but I'm going to be using the VWAP as the stop, right? So I have to name this something that sort of makes sense, because I might use the VWAP as the stop and what I want to size off of for a number of different trades. So it doesn't necessarily make sense for me to call this anything to do with the CWAP. I could, if I wanted to, call it a swing algo, if that helps you. But I find it's very important in the naming convention that we put some key information in there that makes sense for other types of trades, so that I don't have to create a bunch of algos, right? So in this case, I'm going to put VWAP because that's what I'm using as the size off, or the stop. That's my initial risk sizing. And then I want to establish some percent that I'm going to be using of my account at risk. That's the other really key important aspect of algo that puts you in the category of what a professional trader does. A novice retail trader says, I'm going to use an 8-tick stop, and guesses how many contracts they're going to trade. They probably have made up some stupid spreadsheet that tells them how quickly they're going to make $1 million from $5,000 and how they're going to add a new contract every time they make. Well, it's sort of a ridiculous process that I think every aspiring trader has to go through, and then you wake up and smell the coffee. In reality, what you want to do is set yourself up so that you're always compounding your account positively, or when you're in a slump, you're not negatively compounding your account. And in order to do that, we're going to use a fixed amount of our account in terms of a percentage. So that might be 1%, which if you just kind of think about the math for a minute, that means that if you were to start with $100,000 and you risked 1% of it, you were going to be risking $1,000. And if you always risked $1,000, that means that in 100 losing trades consecutively, if that were to ever happen, you would essentially be at 0. But if you're always risking 1%, that means that the first trade you're risking 1,000, and then you're risking 1% of 99,000, and then you're risking 1% of the remainder of that if you were to keep on losing. So what it does is it always reduces, when you're in a slump, the amount that you have at risk. And when you're winning, you're always risking the same amount moving forward. So it increases in size as you're making gains. That's how compounding works. And if you don't understand that, it's very unlikely that you're going to make it down the road as a successful trader, because the bottom line is that, and I don't care what trading room you've been in or what guru's been touting what, you will never make it as a trader as a 1 or 2 lot trader. It just doesn't happen. In order to turn this into a business, you have to do the math. And the math only works out when you are compounding positively Otherwise, you're just going to be at best a break-even trader, which is fairly common. So my suggestion is that based on your account size, and in this case, I'm hoping that it's your sim account, you are establishing something that is fairly realistic. So for example, if the simulator that you're using starts out with a $200,000 balance, let's just say that that's probably not very realistic for 99.9% of you out there. You can go in and change that. In this case, I've put $25,000. Okay, so if I were to risk 1% of my account at $25,000, that means that I'm going to be risking $250 on every trade. Well, I don't know that that's going to be realistic either, but it's a good place. It's a place to start. So you could risk 1%. You could also change this and say I'm going to risk 2% of my account, which in that case would be a $500 amount of risk. And I'm just using that as the baseline. Remember, as our account grows, that number grows. As our account declines, that number declines. So I'm just going to start with 2% as a base number so that you can kind of make your decisions around that. I wouldn't suggest anything more than 4%. But what we want to do is put that in the naming convention. Whoops. So I'm going to put 2% here because based on how I'm doing, I might decide that I want to risk more or less. So I might create variations of this algo. Now you can also go in and insert your commission rate, whatever that might be. Now obviously in Tradevate, unless you're on their free platform, you don't have commissions. You only have the exchange fees. So you might want to put that in as fees rather than commission. In the commission model for most brokers, you'll have some sort of round turn commission. So you can put that in if you would like. So in the case of crude oil, you might have something close to a $4 commission for round turn. You can choose to use an MIT order if you want, which means a market if touched. So you can do that. I don't really recommend it for the style of trading that you're likely to implement in OFA. I would suggest that you'll always want to use limit orders, but that's completely up to you. Now, the next piece is the important thing. What are we going to size off? So some people are confused by what this means, but remember, the idea of an execution algo is to control your risk. It has very little to do with sort of what the natural state of a bracket order would be. That's telling you, okay, I want an entry and a stop somewhere else. What we're saying is we don't know how big the stop is going to be. We have no idea because we don't know what the VWAP is going to be in this trade. It could be 20 ticks away, it could be 4 ticks away, and it could move anywhere in between those numbers. So we have to call it a size off because what we're saying is we know that we want to use the VWAP as our trailing stop, but we don't know how far away that's going to be. So just use the VWAP and then calculate our risk based on where that VWAP is. So we're going to go in and select VWAP for this trade. Now, if we were to leave the offset at 0, that means that our stop would be exactly on the volume weighted average price. I personally would like to be at least a tick behind it, and depending on what market you're trading, you may want to be further behind it than that. So I am going to change this to -1. Now, the negative context simply means that it's always going to be 1 tick further away from the current market price than whatever the value is. So don't think of it in terms of as the market's moving up, -1 means behind it, and then +1 always means to be 1 tick in front of it. If the market's moving down and you use that same math, it would pull the order the wrong way. So negative always means that you're taking the stop further away from the current market value. So in this case, whether I'm long or short, I'm always going to be 1 tick behind the VWAP. Positive would be in front of the VWAP. Now, if you're trading contracts like gold or let me think of another one, maybe the NQ, things that tend to move around a little bit more. In other words, there's not because there's a lot of times less volume, there's more volatility, and when you're trading off the VWAP, you may want to be several ticks behind the VWAP. So maybe you're 4 ticks behind it, and perhaps you get even right at the CWAP or behind it for your entry. These are things that market by market you're going to have to determine. That's part of trading. So as a guideline, I'm going to build this out for you in the markets that I trade. So for crude oil and for the euro and for the YM and for the ES, this would be a logical setup. You will have to make variations of that as you see fit. Now, the next columns are things that you can Up front, just leave blank, but I want you to understand what they are. So you have the minimum size, which means I don't want to execute any trade that has less than, for example, 2 contracts. If I'm putting myself into a trade where the stop is so big that that my 2% of my account only will allow me to execute 1 contract, I don't want to take the trade. So what that's going to do is just override it and say it can't be done. You can do that or not do it. I suggest when you start out, you try not to make it too complex, and then you add those things in as time goes by. The other thing that you can do is say max size. So regardless of what the calculation comes up with, I never want to execute more than 8 contracts, something to that effect. This doesn't make much sense if you're actually really trading a full strategy. This makes sense if you have some sort of insane simulated balance like $300,000, because 2% of that is on a small stop trade is probably going to try and execute 300 contracts. It's not going to happen. It's not real. So you may want to add in some sort of max size. Again, I would leave it blank. Minimum stop just simply means that you're not going to allow the system to place a trade that has a stop less than whatever the value is. This is a fail-safe because sometimes the values from the profiles jump around. And if you're waiting on a trade, say at the point of control, and it looks like it's giving you a 4-tick stop, and you're waiting for the trade to get filled, if the point of control moves and somehow that reduces your stop to, say, 1 tick, you don't want to get into a trade. You don't want to fill a trade that has a 1-tick stop. The likelihood that it's going to drop the bid or lift the offer and take you out of the trade the second that you get filled is just too high. So you might want to have something logical in here like a minimum stop of at least 2 ticks. And then that way, if for some reason the trade gets filled and the trade's about to get filled and the stop gets too close, it'll cancel the order and it'll give you a little message that says that your risk parameters are set where the minimum stop is being exceeded. And you know what the reason is for that. So if you get any sort of error that says something about the risk sizing, it's due to these settings here, and you just need to go in and make sure that they're logical. I find that very often people put such huge constrictions on this that they can't get a trade filled. And then they get mad because they keep getting this pop-up error message. Well, the reason you're getting it is because you're saying, the only way I can ever get filled on any trade is if I have a 6-tick stop. You know, if you're going to limit yourself that much, you really don't, there's no need for you to trade with Algo. You should just manually trade and use a 6-tick stop. It's sort of foolish. So be realistic about it. And then obviously you can also say, look, if for whatever reason I hit the button and the stop is too big, I don't ever want to take anything that's more than a 20-tick stop. As you get more and more in tune with OFA, you're going to realize why this is here. And the reason is that what we're doing is playing the probabilities of where the market's going to move quickly without any sort of pullback. So, for example, if I'm trading crude might move 30 ticks without having any sort of challenge of my stop. Okay, so that means that I can likely get 30 ticks out of something. So if I have a 20-tick stop, I can't even get to 2 to 1 before the market's likely to pull back. Right? So taking something with a 20-tick stop means that I'm going to have more intrinsic risk, not because it's a larger stop, but because the market's very unlikely to move, say, 40 ticks or 2 times what I'm risking without having a challenge of my entry. So you might say something to the effect of, I don't want to take a trade that has more than like a 16-tick stop. It's totally up to you. Again, when you start out, I would leave all this stuff blank. You can also auto-cancel. So after a certain number of minutes of resting an order, if it doesn't fill, you can have it cancel. You can do the same thing based on bars. And then you can also include any other open trades in your risk sizing. So I used the example of $100,000 earlier. If my account size was $100,000 and I had other trades on in different instruments, and I'm saying now I want to place a new trade on, and I want to use 2% of my account. If I don't check this, it's going to actually use my account balance. If I check this box, it's going to take all of my open positions and say, what happens if they all got stopped out right now? If every one of them got stopped out, what would your account balance be? And that's what it's going to size off of, is the remaining account balance, so that you don't ever overextend yourself because you're in other positions. So if you want to check that box, fantastic. Then you're just going to add it, and now you have an execution algo. So that means that we can go over, and from the list, we can pull down our VWAP execution algo. So now, under these circumstances, if I were to send a long trade, I would send a trade to the CWAP. My stop would be 1 tick behind the volume weighted average price. Now, even though we're down on it and we're coming to it, I can't do that yet because I haven't set up the other pieces of the algo. So I'm going to quickly set up a profit algo. When we do profit in OFA, what we're saying is I want to get the orders out there. I want to get my targets out there, very much like you would have a bracket order, except we want them to be logic-based. We don't want to trade and just have it be some sort of tick multiple. What we're looking for is to get orders out on the chart so that we can dial them in if we need to, and we want them to be multiples of what we're risking. Okay, so any profit or management algo is going to be built in steps. So to add one, we're just simply going to hit the plus button, and we're going to name the overall algo. This is what we're going to call this one. So in this case, I'm just going to put standard 5 because I'm going to try to use 5 targets. But of course, I don't know how many contracts are going to get executed. But this is going to put out 5 targets for me. And I'm also going to tail in this naming convention with 100%. And the reason I'm going to do that is because I want to know when I pull this down that this will close out the entire position if we hit the last target. Now, I might create a variation of this where I leave a runner on. So I'm not going to close out 100%. In other words, if I want to take some profit along the way and then I just want this thing to run as long as it can until my trailing stop is picked up, I might not end this with 100%. That way I know that that other algo means that the trade can continue to run and run and run. Okay? So I've named it. Now I got to start creating steps. I'm going to go in and hit plus. And for this one, I'm just going to say, okay, at 2 to 1, I want to take 50%. That way I know what the step is going to do without looking at any of the other information. So that means at 2 to 1, I'm going to change the ratio, and I'm going to say at 50%, take 50% of my position off. So in simple math, if I had 10 contracts on, at the 2 to 1 level, I'm going to take 5 of them off for profit. Now, if I have an odd number of contracts on, it's always going to round down. So if I had 9 contracts on, I can't take off 4.5, but it'll take off 4, which will leave 5 remaining for the other steps to take out. So I'm going to click Add. I'm going to come in and set up another one at 3 to 1, and I'm going to leave that at 50% as well. Then I'm going to do 4 to 1, 50%, change this to 4, click Add, and now I'm going to do 5 to 1, and on this one I'm going to take 100%, which means I want to close out the entire position. So at 5 to 1, whatever is left, take 100% of my position. Okay? So I only have 4 steps in here. I call it standard 5 because I always use the number of the last multiple. So if I wanted it to be 7.5 to 1, I would have it standard 7.5. Okay, so it's not, in my naming convention, it's not the number of targets, it's what I'm trying to get to in terms of a return. So I'm going to add this, and now we have a profit. Oops, let me close this. We now have a profit algo that we could use, standard 5. Right? So now I need to create a management algo. So management algos can get extremely complex. And once you have really sort of built up your concept of strategies and how all these trades start working, then it makes a lot of sense for you to create sort of complex ones. And an example of that might be, let me give you an example. If we were to trade off of a breakout trade, or in this case maybe a double top, we would be using the value area as our initial size off, and we'll build that algo in the next video. If we started with a stop at the bottom of value, at some point along the way we might want to move that. So let's just assume we go long and our stop is down here below the value area low. Then at some point we want to move our stop up. So we move it up to the VWAP. And then as we advance further, maybe we want to move it up to the CWAP. And then as we advance further, maybe we want to move it all the way up to the top of value, or we want to move it to the first standard deviation or the second standard deviation. I want you to think about how precise that is. So you're going to have trade setups over time where you take the 4 basic setups and you start to learn variations of them, or where you drill it down. So let's say that for a trend-based trade, maybe we have 3 different variations of it. One where the market is trending very much at like a 45-degree angle. We're having a nice, smooth upswing. I might use a strategy for that where I know, because of the way that the market's moving, that it's very likely that this is going to sort of taper out over a very steady, easy flow. So I might just want to leave my stop at the volume weighted average price, and I don't want to do anything else with it unless there is a major change in the market structure, in which case I can always manually come over and move my stop using the buttons over here. I can also drag it and drop it if I want to, but we're always trying to use the market data for our variables, so move stop is always going to be a better option for you. And as you see several examples and whatnot, you'll really start to make sense of that. Now let's say that there's another variation, and that variation is that the market screams. So let me see if I can find. So look at this breakdown. This is not 45 degrees, right? It's more like 65. The market is slamming down, and when that type of thing happens, we usually have the market scream in one direction and then eventually stop and just go flat or turn right back around. So it doesn't generally trend out a long, smooth trend. So I might have a completely different management setup for when I'm looking at that type of trade. And in that case, what I might want to do is say, well, when we get to the when we start out and we get to we break the 3-to-1 profit target, after that point, I want my stop to go to the first standard deviation. So my stop is going to start trailing here, getting much, much closer. And let's say once I get to 5-to-1, I want it to go to the second standard deviation because I'm trying to give it as little room to come back and pummel me as possible, such that by the time we've gotten down here, my trailing stop is now here, right? It could even be the 3-to-1, the third standard deviation. In other words, based on the experience that you get with the different variations of these 4 types of trades, you're going to see different management opportunities that you can just automate because you see them over and over and over again. That generally is not going to be the case when you first start out. When you first start out, my expectation is that you're using management just for some very simple moves, maybe even just one very simple move, and from there you're learning to trade that situation, and so you're using the move stop buttons. It will be much more effective for you. So if that's the case, then what I need to do is set up just a very simple management algo that I can use across all 3 algos. Okay, so I'm going to go in and click the management algo. I'm going to add, and again, I'm going to name this. So I'm going to call this a simple VWAP. All right, now our stop in this particular trade is already going to be on the VWAP. So there's not much reason for me to create this for this particular algo, but you'll find that it will make sense with the other trades. So I suggest that you just build this one out as kind of your default, and then as you want it to get more complex, you certainly can. So I'm going to call this VWAP, and I'm going to call this VWAP 3-to-1. That means that once the market moves 3-to-1 in my favor, no matter what's going on, no matter what type of trade I have, I always want the stop to get moved to the volume weighted average price minus 1. So remember, that's a tick lower in a long and a tick higher in a short. Okay. Now, as I said, this isn't going to affect this particular trade at all because our stop's already 1 tick off the VWAP. But I can use this for other scenarios, and it's important that I start thinking in terms of the volume weighted average price, because if I'm in any sort of move that's a directional move and I've got the profile drawn right, the VWAP is the point at which the trade no longer makes sense anyways. You don't want to be in a long where all of the trade is trading below the volume weighted average price. It just doesn't make sense, and vice versa for a short. So that's a good place to always sort of park your stop as a default. So if it's not already at the volume weighted average price, that step is going to get it there. And now we can go down and click and add the simple VWAP. That's it for the trend algo. So that should get you started. I'm sorry the video is so long. The next 2 will be a little bit shorter, but we're going to build the other 2, and I'm going to talk to you about some of the things that we will use, like the sticky stop. I also want to bring to your attention that on the website, you can go into your training videos, which under My Account, Tutorials and Courses, and each one of the platforms has a detailed tutorial. So for example, if I go to MotiveWave and I click on this, it's going to pull up and it's going to give me all of the videos, right? So in this case, I can go and look at the AlgoX section, and I can look and go through execution algos, and all of these different steps are drawn out in shorter, more concise videos. So you may not want to watch this one again because it is coming on 25 minutes now. So if you want to go in and just learn the specifics of any subsection of this bigger video, you can go in and check out everything that you need to know about the platform and specifically about building these algos. In the next video, we'll do the decision point algo, and then we'll do one more video on the other ones, and you'll see how we can use both of those trades. We can use one single algo for it.